Hey everyone, welcome back to Corporate Decoder, the place where we break down those dense financial documents so you don't have to, especially when the numbers show more than just profit and loss. Atmos Energy Corporation's latest quarterly report has landed, and while these companies usually report steady as she goes, we're going to look for the cracks and the gems buried in the numbers, especially in their financial statements. And before we dive in, if you like this kind of no-nonsense financial breakdown, make sure you hit that subscribe button. Also, we have a Discord community where we chat about these filings, so join us there. Link is in the description. Alright, let's get straight to the heart of what really matters the money. So looking at their balance sheet for the 31st of December 2025, we see their property, plant and equipment is sitting at a hefty $30 billion. That is a lot of assets. Against that, they have accumulated depreciation and amortization of about $4 billion. This means their net property, plant and equipment, a crucial number for a utility, is around $26 billion. This represents a significant increase from last year, reflecting their ongoing investments in infrastructure. When we look at their current assets, cash is up to a little over $371 million from about $203 million at the start of the quarter. This is a good sign, showing they have more immediate cash available. Accounts receivable also jumped significantly from $375 million to over $731 million. This signals more sales or potentially slower customer payments, which we will have to keep an eye on. Now let's flip over to the other side, the liabilities and shareholders' equity side. Their shareholders' equity has grown to over $14 billion, which is a healthy increase from about $13.5 billion. This is driven by a substantial increase in additional paid-in capital to over $8.7 billion from $8.2 billion, showing they raised a lot of money through stock. Retained earnings also grew nicely to over $5.1 billion. Term debt is also up to over $9.5 billion from about $8.9 billion. So while they are growing and raising capital, they are also taking on more debt. Moving on to the income statement for the 3 months ending the 31st of December 2025. Total operating revenues are up to $1.34 billion compared to $1.17 billion in the same period last year. That is a jump of about 15%. Purchase gas costs also went up to $295 million from $234 million. This is expected as they sell more gas. Operation and maintenance expenses saw an increase to $229 million from $207 million. This is likely due to increased staffing and system upkeep. Depreciation and amortization also rose to $194 million from $180 million, reflecting the new assets coming online. Here is a key number: operating income. It increased to $514 million from $459 million. This is a very positive sign, showing that the company is becoming more profitable from its core operations. With interest charges lower than last year due to fewer outstanding debt balances, overall income before income taxes is up significantly to $503 million from $431 million. Net income is also up to $402 million, a strong 14.5% increase from $351 million in the prior year period. This translates to diluted earnings per share of $2.44 compared to $2.23. That is a solid improvement for shareholders. Now let's talk about cash. For the 3 months ending the 31st of December 2025, cash flow from operations was $308 million, up from $282 million in the same period last year. This increase is largely attributed to the positive outcomes from their rate cases, which is how they get regulators to approve their spending. However, investing activities show a significant outflow of cash. They spent over $1 billion on capital expenditures this quarter compared to about $888 million last year. This is a huge investment, mostly in their distribution and transmission systems, aimed at safety and reliability improvements. On the financing side, things are busy. They brought in over $895 million from financing activities compared to $887 million last year. A big chunk of this came from equity issuances, totaling over $472 million. They are actively selling stock to fund their operations and growth. They also issued new debt totaling over $596 million, continuing their strategy of balancing debt and equity. Dividends paid also increased to over $160 million, reflecting their commitment to returning value to shareholders. Under the section detailing their accounting policies, we see that they follow us generally accepted accounting principles. They are a rate-regulated entity, meaning their costs can be recovered through customer rates if regulators approve. This is a critical aspect of their business model. Looking into the specifics of their regulation, you'll see notes about infrastructure mechanisms and Winter Storm Uri incremental costs. This means they get to capitalize costs that would normally be expensed if they can show these costs are for reliable infrastructure or to recover from extreme events. They record these as regulatory assets. meaning they expect to get that money back from customers down the line. The company breaks its operations into two main parts, the distribution segment and the pipeline and storage segment. The distribution segment is where they deliver gas to homes and businesses, and it makes up the bulk of their revenue and assets. The pipeline and storage segment is more about transporting gas and storing it for later use. In the distribution segment, revenue from external parties hit $1.25 billion for the quarter, up from $1.1 billion last year. The pipeline and storage segment brought in $84 million from external parties compared to $67 million last year. This shows growth across both segments, with distribution still being the dominant force. Their operating income for the distribution segment went up to $349 million from $316 million last year. This is a solid 10.5% increase. They credit this to rate adjustments, consumption growth, and customer growth. These are all positive indicators for their core business. For the pipeline and storage segment, operating income increased to $165 million from $143 million. This is a 15.4% jump driven by rate adjustments and higher contracted capacity. It seems both parts of their business are performing well. Let's briefly touch on earnings per S-Hair. For the 3 months ending the 31st of December, 2025 diluted earnings per S-Hair were $2.44, a nice bump from $2.23 in the same period last year. This is an important metric for investors as it shows the profitability attributable to each share of common stock. The debt section gives us a clear picture of their borrowing. They have a lot of senior notes outstanding with varying interest rates and maturity dates. For example, they have $600 million in 5.45% senior notes due in January 2056. They also issued $600 million in new 5.45% senior notes due in January 2056 on the 1st of October 2025. This suggests they are actively refinancing and extending their debt maturities. They mention debt covenants, which are basically promises they make to lenders. Right now, they are in compliance with all of them. Their total debt to total capitalization ratio is around 41%, which is well below the 70% maximum allowed. This indicates a strong financial position from a debt perspective. Looking at shareholders' equity, we see they issued about 3.7 million shares through public offerings and other stock plans during the quarter. This contributed significantly to the increase in additional paid-in capital. They are actively using the equity markets to raise capital for their investments. In the pension section, we see the company is managing its retirement obligations. Most of these costs are eligible for recovery through customer rates, which is good for their bottom line. Under commitments and contingencies, we find some important information about potential risks. They mention ongoing legal and regulatory proceedings and that they believe any outcomes exceeding their current accruals will not materially impact their financial position. They highlight 2 incidents investigated by the National Transportation Safety Board that resulted in fatalities. While these are serious matters, the company states they are cooperating and believe the final outcomes will not have a material adverse effect. This is a crucial point for assessing potential liabilities. The fair value section provides insight into how they value certain assets and liabilities. For their long-term debt, the carrying amount is over $9.5 billion, but the fair value is around $8.7 billion. This difference indicates that the market values their debt less than its book value, perhaps due to current interest rate environments or company-specific risks. So what does all this mean? Atmos Energy is a company that is heavily regulated and invests aggressively in its infrastructure. They are growing revenues and income, which is positive. They are also actively raising capital through both debt and equity to fund these investments. The key risk is always regulatory approval for their rate increases and managing potential liabilities from incidents and environmental matters. Their strong debt covenants and equity issuance show they are effectively managing their financing. Overall, Atmos Energy appears to be navigating a challenging but steady course, balancing infrastructure investment with shareholder returns. The continued focus on safety and reliability through significant capital expenditures positions them well for the future, but the regulatory landscape will always be their primary driver of success. Alright, that is our deep dive into Atmos Energy's latest report. What do you think? Are these investments in safety a good sign or a red flag for rising costs? Let us know in the comments below, and if you found this helpful, hit that like button and subscribe for more. Don't forget to join our Discord community as well for ongoing discussions. Thanks for watching, and we'll see you in the next one.